Somewhere, right now, a computer is judging you. It's looking at how you've handled money for the past 7 years and assigning you a number that will determine whether you get that apartment, that car loan, or that credit card with the fancy metal design. You've never met this computer. You've never had a conversation with it. It doesn't know that you're a good person who volunteers and calls your mum on her birthday. It just knows you paid your Verizon bill late in 2019, and it will never ever forget. Today we're breaking down credit scores, what they actually measure, why the rules are dumber than you think, and how to game this absurd system in your favor. Welcome back to Capital and Capybaras. We've covered compound interest, emergency funds, paychecks, and budgeting. Now it's time for the boss battle of personal finance, understanding your credit score. Here's what nobody tells you. Your credit score isn't a measure of how responsible you are with money. It's a measure of how profitable you are to lenders. That's it. The whole system was designed by credit card companies to predict whether you'll make them money. Once you understand that, everything else makes a lot more sense, including the parts that seem completely insane. Let's start with the basics. A credit score is a 3-digit number, usually between 300 and 850, that predicts how likely you are to repay debt. Higher is better. 750 and above is excellent. 700 to 749 is good. 650 to 699 is fair. Below 650, and you're going to have a harder time. Below 580, and landlords will look at you like you just confessed to arson. Now here's where it gets confusing. You don't have one credit score. You have dozens. There are 2 main companies creating these scores, FICO and VantageScore, and each has multiple versions. FICO alone has over 50 different scoring models. The score you see on Credit Karma might be different from what a mortgage lender sees, which might be different from what an auto lender sees. It's like finding out your teacher has been grading you on a different rubric than the one they handed out. Welcome to American finance. For most purposes, your FICO score is what matters. About 90% of lenders use some version of FICO. VantageScore is what most free apps show you because it's cheaper for them to access. It's usually close to your FICO score, but not identical. Think of it as a movie trailer for your actual credit score. It gives you the general idea, but don't be surprised if the final product is slightly different. Your credit score is calculated from 5 factors, and they're not weighted equally. Understanding this is how you game the system. Factor 1. Payment history. This is 35% of your score, the biggest chunk. It answers one question: do you pay your bills on time? Every late payment over 30 days gets reported and stays on your report for 7 years. The system has the memory of an elephant who's also holding a grudge. Factor 2. Credit utilization. This is 30% of your score. It measures how much of your available credit you're actually using. If you have a credit card with a $10,000 limit and you're carrying a $5,000 balance, your utilization is 50%. The scoring models want this under 30%, ideally under 10%. Here's the absurd part. This factor has no memory. If you pay down your balance today, your score improves as soon as it's reported. Unlike payment history, utilization doesn't haunt you. The system literally forgets last month's utilization the moment new data comes in. Factor 3. Length of credit history. 15%. This includes the age of your oldest account, your newest account, and the average age of all accounts. Longer is better. This is why closing old credit cards can hurt your score. You're shortening your average account age. It's also why starting to build credit at 18 is easier than starting at 30. Time is literally a factor. Factor 4. Credit mix. 10%. The scoring models like to see you can handle different types of credit cards, auto loans, mortgages, student loans. This doesn't mean you should take out a car loan just to diversify your credit portfolio. That would be insane. But if you're deciding between financing a car at 0% or paying cash, the credit mix factor is something to consider. Factor 5. New credit inquiries. 10%. Every time you apply for credit, a hard inquiry appears on your report. Too many inquiries in a short period makes you look desperate, which makes lenders nervous. However, and this is important, rate shopping for mortgages, auto loans, or student loans doesn't count against you if you do it within a 14 to 45-day window, depending on the scoring model. The system assumes you're comparison shopping for a single loan, not frantically applying everywhere. Now let's destroy some myths that refuse to die. Myth 1. Checking your own credit score hurts it. No, that's a soft inquiry. Only hard inquiries from lenders affect your score, and even those only matter for about a year. Check your score as often as you want. The apps are free. Go wild. Myth 2. You need to carry a balance to build credit. Absolutely not. This is a lie perpetuated by people who profit from interest payments. Pay your balance in full every month. The scoring system only cares that you're using the card and paying on time. It doesn't care if you're paying interest. Carrying a balance just costs you money for zero benefit. Myth 3. Closing a credit card always hurts your score. It depends. If it's your oldest card, yes, it could hurt because of the history factor. If it's a newer card with no annual fee, keeping it open is probably fine. If it's a newer card with an annual fee you're not getting value from, close it. The utilization impact is usually temporary. Do the math, not the panic. Myth 4. Income affects your credit score. Your score has absolutely no idea how much money you make. A billionaire with no credit history has a worse score than a barista who's been responsibly using a secured card for 3 years. The score only knows what's in your credit report. Payment history, accounts, balances, inquiries. Your salary isn't in there. You have the legal right to check your actual credit reports for free once a year from each of the 3 bureaus, Equifax, Experian, and TransUnion at annualcreditreport.com. That's the official site, not freecreditreport.com, not Credit Karma, not any other site. Annualcreditreport.com. Bookmark it. This gives you the actual report, not just the score. You can see every account, every inquiry, and every potential error. For your actual score, most credit cards now offer free FICO score access through their app or website. Discover, American Express, and most major banks include this. If you don't have a credit card, Credit Karma and similar apps show you Vantage Score for free, which is close enough for monitoring purposes. Check quarterly, catch errors early, and watch for identity theft. If someone opens a credit card in your name, you want to know before they max it out buying TVs. Let's talk about actually improving your score. Quick win number 1. Set up autopay for at least the minimum payment on everything. Payment history is 35% of your score. One missed payment can drop your score by 100 points. Autopay removes the possibility of forgetting. You can still pay more manually, but the minimum is covered. This is non-negotiable. Quick win number 2. Request a credit limit increase on existing cards. If you have a card with a $5,000 limit and get it raised to $10,000, your utilization instantly drops, assuming your balance stays the same. Most issuers let you request this online without a hard inquiry. Free improvement. Do this every 6 to 12 months on cards you've had for a while. Quick win number 3. Become an authorized user on someone else's old account. If a parent or partner has a credit card they've had for 20 years with perfect payment history, being added as an authorized user puts that account on your report. You don't even need to use the card or even have it. You're just borrowing their good credit history. This is especially useful for young adults building credit from scratch. Quick win number 4. Dispute errors on your report. Studies show about 1 in 4 credit reports have errors. Wrong addresses, accounts that aren't yours, late payments that were actually on time. Dispute these through the Bureau's website. They have 30 days to investigate. If they can't verify it, it comes off. Free points for paperwork. Quick win number 5. If you have no credit history, get a secured credit card. You put down a deposit, usually $200 to $500, and that becomes your credit limit. Use it for small purchases, pay it off monthly, and you'll build a score within 6 months. After a year or so, you can usually upgrade to an unsecured card and get your deposit back. Here's the perspective nobody gives you. Credit scores matter a lot for certain things, and not at all for others. They matter for mortgages. A better score means a lower interest rate, which can save you tens of thousands over 30 years. They matter for auto loans, apartment applications, and sometimes job applications in finance. They matter for getting approved for credit cards with good rewards. They don't matter if you're paying cash. They don't matter for your investment returns. They don't matter for your net worth. They don't matter for your value as a human being. I've seen people obsess over getting their score from 780 to 800 like it's a video game achievement. Past 760, you're getting the best rates on everything. The difference between 760 and 850 is bragging rights and nothing else. Don't optimize for a number that stopped mattering 3 tiers ago. Let's recap. Your credit score is a game invented by lenders to predict profitability. It's calculated from 5 factors: payment history, utilization, length of history, credit mix, and new inquiries. The system is designed by credit card companies, has the memory of a vindictive elephant, and forgets utilization the moment you pay it down. Check your reports at annualcreditreport.com, check your score through your credit card app, and dispute any errors. Set up autopay, request limit increases, and stop carrying balances to build credit. That's a myth that costs you money. Once you hit 760, stop optimizing and go live your life. If this demystified the 3-digit number that's been stressing you out, hit subscribe. Next episode, we're tackling investing for beginners, how to actually start, why it's less scary than you think, and which accounts to use. Spoiler, if your employer offers a 401k match and you're not taking it, you're literally declining free money. Drop a comment. What's your biggest credit score question? And if you've successfully gamed the system, share your wins. The comments section is better than most credit repair services. Stay chill, set up autopay, and remember, past 760, it's just a number.